Hello friends, this is Vijay here. I'm back with you in my weekly market outlook videos. I'm going to help you decipher what the market indicators mean and how you can stay ahead of the crowds using my in-house studies and parameters that I assure you will not find anywhere else on the internet. Last week, there have been some very important updates in the bond markets, and this is something that I have been tweeting on, not only tweeting, but putting it across all my social media accounts on Facebook, LinkedIn, Twitter, YouTube, etc. That this was along expected lines. And believe me, what has happened last week is likely to critically impact your both investments and your trades. And in this video, in the bond market segment, I'm going to update you about what has really happened and what you need to do to stay ahead of the curve. So let's dive right in and see what happened in the market last week so as to guesstimate what can come in the days ahead. Coming up on your screen is the market roundup window, and you can see that the markets rallied last week, and it was the banking stocks that led the charge on the upside, and the bank Nifty gained marginally higher than the Nifty 50. The US dollar index, the Dixie, fell sharply, which boosted emerging markets, including India, because imported inflation fears basically reduce on a falling dollar. Bullion rose mildly because gold gained slightly and silver eased a little bit. Unfortunately, a weak dollar also triggered a rise in oil and gas prices, which were also boosted by geopolitical tensions that I have been warning you about since months in Eastern Europe and about a month ago in the Middle East. Now, these stresses and strains are likely to keep oil and gas prices on the boil, and inflationary fears will continue to rise, especially in import-dependent economy like India. Now, our markets haven't really reacted much to this because prices at the pump haven't risen too much. They will possibly rise, say, in the middle of the coming month. What you can see on your screen is also the fact that bond yields shot through the roof to hit their highest after June 2019. Pay particular attention to the bond segment in this video. Unless you're bored to death of bonds and you wish to avoid this segment, you can skip forward. But if you're trading banking stocks, especially the bank Nifty, I assure you, you're going to harm yourself by skipping the bond segment, because this is where a majority of the structural shift in the financial markets took place last week. Now, the NSE market cap rose 2.59% on a week-on-week basis after falling more than 3% for 2 consecutive weeks. On your screen, you can see that the MWPL chart shows a rise in market-wide commitments of traders, which is routine till the third week of any derivative cycle. Risk appetite seems to have improved with gains in the markets. We need to see whether this sustains, and if it does, it should sustain till the third week. The overseas cues seem to be positive for now because the 3 indices that I have added since a week ago, the Dow Jones, the Nasdaq, and the Standards & Poor's 500, seem to be positive for now on a week-on-week basis. Now let's take a look at the basis chart on your screen. The basis is nothing but the premium enjoyed by futures over spot. Now, on a week-on-week computation, the basis was marginally lower because selling at higher levels coupled with time decay as expiry approaches, it's called time decay, it eroded the risk premium. The Nifty basis went into inversion on Thursday ever so briefly, but returned back to positive zone on Friday. Watch out for basis inversion in the coming week, because that would indicate to me that sellers are getting more and more aggressive. Now let's take a look at the index and stock futures volumes of three cumulative series, which is February, March, and April. They saw a lower participation in stock futures, whereas there was a mild increase in trading participation in stock futures. For a rally of this magnitude that we saw last week, I would have ideally wanted higher turnover. However, of the two engines that I monitor, volumes and open interest, at least the open interest is rising. So we have a 2 marshmallow gain in the markets last week. I'm going to record a very short video on the marshmallow theory in behavioral technical analysis. So do bear with me about what the marshmallow theory is. So for now, the highly reliable study that we've banked on for so long, and it's from our statistical model, the IBEX, is on your screen now. I'm talking about the impetus chart, which shows a rising velocity on the Bank Nifty, both on the upside between Monday to Wednesday last week, as well as on the downticks on Thursday and Friday. That tells me that volatility can possibly go through the roof in the banking stocks and the Bank Nifty in the coming days. The impetus reading on the Nifty has fallen progressively for 5 trading sessions, which means the rally with gaps on Monday to Wednesday wasn't really convincing as far as statistical internals were concerned, nor are the falls of Thursday and Friday. Do note, neither the rally nor the falls were on rising impetus, which means compared to each other, the two indices, which is the Bank Nifty versus the Nifty 50, all other factors remaining equal, which means no other news flow coming in, I feel the Bank Nifty will see higher percentage volatility in the days ahead, whereas the Nifty is likely to be relatively quieter. That is, of course, unless a new data point or news flow emerges, as I said. Now let's take a look at the footprint of the 4 types of market participants to see what they did. Where the FIs are concerned, their index futures net long positions went up to 67,014 lots, which was last week 26,096 lots. Their stock futures positions were net short of 27,175 lots, which was a net short of 63,671 lots last week. Where DIIs are concerned, their index futures net shorts went down to 38,535 lots, which last week was 40,853 lots net short. Where the stock futures are concerned, their net shorts fell again to 16,30,934 lots, which was 16,49,412 lots. Where proprietary trades are concerned, these are super sharp brokers' own proprietary trades. They are second best to insiders because they know who's buying and how much. So their trades tell you a story of a different kind altogether. Where prop traders are concerned, they reduced their index net long positions to 2,368 lots from an earlier last week 23,775 lots. Where stock futures are concerned, they cut their stock futures net long positions to the level of 2,07,535 lots, which in the previous week was 2,10,325 lots. Now let's take a look at what retail traders are doing. Now these guys have been doing all the heavy lifting, so they become a lot more critical to monitor. Their index net long positions fell marginally to 63,342 lots, which last week was 80,749 lots. Their individual stock futures net long positions fell also to 13,56,384 lots, which in the previous week was 14,12,991 lots. Now, what we've seen so far tells me that FIIs are cutting their shorts, as are the domestic investment institutions, the DIIs. Prop traders are reducing their long positions, and so are retail traders. Now, prop traders are what I would call as specialists. So if they are reducing, you should be sitting up and taking notice of what's happening in the market. Let's be careful out there, guys. Now, friends, I come to the most critical aspect of this video, the 10-year benchmark bond yield and what it indicates. Now, this is by and far the most critical of all segments in this video. Like I told you, note how the 10-year benchmark bond yield has hit almost 7%, which means traders are selling Indian bonds and the prices are falling, which is pushing yields higher. Why are the bond traders selling bonds? Because they are expecting that the bond markets will see higher interest rates in the immediate future. Now, bond markets are for big boys who write multi-million or even billion-dollar checks, and it is their money that moves the needles and gauges in the markets. So if they are selling old series of bonds, either to buy new series of higher interest bearing bonds, or they are selling the old series of bonds and sitting on cash to deploy whenever new series of higher interest bearing bonds are launched, you have to be very careful. All right. So far, I've been updating my followers on social media about smaller economies that have been raising interest rates like Poland, Romania, Peru, Argentina, Brazil, Chile, and Russia. But, and this is important, last week the Bank of England triggered an EMP, what is known as electromagnetic pulse. Now, whenever a nuclear bomb or a nuclear device is exploded, ripples of shocks kind of spread out, and this ripple effect is called EMP. It impacts everything, including electrical, thermonuclear kind of impulses, etc. There's this kind of very disruptive. So the Bank of England, which was expected to, if you've been following me on social media, which was expected to raise rates on their 4th of November 2021 meeting, decided to do it last week. And I'll tell you in a minute as to why it was equivalent to an electromagnetic pulse. Now, after these smaller economies, England was the first major top 4 or top 5 economies in the world to start raising rates. Why is this important, you may ask me? Because of the cash and carry trade. I've explained to you in my earlier videos that money is agnostic and the only thing that it seeks is higher yields. So it exits those countries where interest rates are low, and it moves into those countries where interest rates are higher. Now, because England has raised its interest rates, it can cause a rate war thanks to the cash carry trade. And note how the US dollar index fell immediately after the British Bank of England raised interest rates. It is because the markets punished the US dollar saying, hey, you guys need to raise rates, otherwise we are leaving your country. All right. Now, what will happen is that it will force America, it will force Germany, it will force Japan, it will force France to basically start raising rates again. Now, this is a rate war of a different type. Instead of racing to the bottom, countries are now going to race to the top as to who's raising rates faster. It'll happen. By faster, I mean, you have to understand in the bond market, faster does not mean hours. Faster means months. Okay. But the equity markets being radar sensitive will start to respond. Allow me a few minutes and I'll explain how and why. Now, the other Euro countries will be basically forced to raise interest rates. And what do you think President Joe Biden will have to do in a midterm election year? He'll be forced to support the dollar by raising rates too. So cash carry compulsions will force everyone to start raising rates. And as I've been updating on my social media accounts, nations whose bond yields have started zooming and therefore are sniffing and basically getting hints about rising interest rates are Germany, USA, Japan, and possibly even other Eurozone countries. As you would have seen on your screen, I've shared screenshots of my social media accounts. I've been updating my friends and followers on social media. Do connect with me. My contact coordinates come at the fag end of this video. I update all these turnover figures, basis, etc., MWPL data, which you can update yourself and help yourself become better traders. Now, there was also this flash update that I sent to you via WhatsApp on Thursday morning, early morning, before the markets opened, about the banking and the bank Nifty trades based purely on the bond market yields. Now, do you remember my WhatsApp update, as you can see on your screen? And if you had paid attention to it on Thursday early morning, you would have saved yourself from a crippling decline of 540 rupees on the Bank Nifty on Thursday and Friday. Please do keep monitoring your inbox from my WhatsApp updates. They are free. And if you are not already on the broadcast list and wish to be included, please do send an email at the mail ID that you see above on your screen, mentioning your full name and a mobile number on which you have your WhatsApp installed. I'll get you going immediately. As I reminded you, this is a completely free and complimentary feature of our BSPL India. So, if you wish to recommend your friends also to receive our updates, do send me their contact coordinates with names, and we'll be happy to help you out. Now that we've established what's likely to happen in the ocean called the bond markets, you may ask me, hey Vijay, why should I bother? And how do I use this data to shuffle my investments? Remember the two things that I always tell you across my communication, whether it's on social media or personal upfront. Number one, we traders are brain warriors. We fight, we win and lose with our heads, with our ideas. Number two, the market is like a chessboard. Your and my money are like the pieces that we shuffle and move on the chessboard. How you shuffle and move the pieces on the chessboard will determine whether you will make money or lose money in the market. So, move your pieces very well. Now that we know that interest rates are going to rise, cost of funds are going to go up, it's time to reshuffle the pieces on the chessboard. All right? So, here I'm going to give you a few leads about what you should be doing. Now let's talk about money as a raw material and or finished product. Okay, you all know that companies whose raw material prices are going to go up will make a lower profit unless they can pass on the entire cost increase to their purchasers. And if at all a company's finished product price is going to go up, its profitability will also rise because it's going to get more rupees per unit. Now, look at those sectors and industries which are likely to suffer because money is their raw material. And therefore, their input cost is going to go up. Let's talk about a few sectors. For example, I'm using the words for example, NBFCs, non-banking financial companies, consumer good companies which depend on EMIs as a major source of their sales. Now, these companies will start to feel the crunch. Maybe, selectively speaking, of course, you need to shuffle your chess pieces on the game of chess in the market out of these companies into better areas. All right. Now, consumer good companies which depend on EMIs as sales, for majority of their sales are primary examples of what is going to go down. Note how the NBFC stock prices are placed compared to their recent peaks. Now you know what I mean. Whether it is HDFC Limited or it's the Bajaj Finance stock price. Do remember a couple of weeks ago I told you that HDFC Limited was one of the first NBFCs to start raising interest rates. Although it raised interest rates by 10 basis points, but ever since it announced interest rate hikes on 1st of December, HDFC Limited's stock price has been under pressure. This is precisely what I mean. If you want to stay ahead of the curve, you have to stay ahead weeks and weeks ahead. Initially, you might look your way off the mark, but believe me, in the end, we are going to have the last laugh. So, obviously, people will buy less on EMIs because interest rates rise, so their stocks will slow down on the upward momentum slowly but surely. Most traders will not notice it because it's a slow grinding process. By the time the janta or the average guy notices, it'll be too late. So, will I warn you when rates are peaking out so that we start to buy these stocks again? Yes, of course I will. Will I send you instant WhatsApp updates if something happens to the contrary and the market tells you, hey, we need to change our minds? You can bet on it. It's going to happen. So keep monitoring your inbox. But do note, I don't believe in stock tips. So I'm not going to give you herd on the street, whispers on the streets, etc., etc. None of that stuff. It's going to be pure market gyan and you can act upon it quite well on your own. So the sum and substance of this segment is higher interest rates will impact everything from cost of carry, which is the amount of money you pay to carry your long position forward in futures from one derivative expiry to the next, including your options premium. And it might also impact, this is quite important, the capital allocation of mutual funds from equity schemes to debt market schemes over a period of time. So I want my friends to have an edge over others and lead the markets from the front. Like I said earlier, if I appear to be wrong for a brief period of time, it's okay with me. I'm perfectly fine with it. I've been there many times before. As long as I have the last dance with the prom queen and I take her home, it's all fine with me. So friends, don't let anyone convince you that bonds, forex markets or commodity markets don't really matter to equity traders and investors, because all these markets are married to each other and in bed with each other, and money goes out with one or more of them for a honeymoon at its own choice. Just keep watching the money trail of the big boys and you're going to be safe. All right. So just keep an eye on where money is flowing out and where money is flowing in. That's where majority of the profit potential resides. Friends, let's now go to the US dollar index, the Dixie, which fell 1.79% on a week-on-week basis after logging 4 out of 5 days of declines. And the fall was particularly escalated after the Bank of England raised interest rates. Remember what I told you a minute ago about the cash carry trade. I want to explain to you why I'm suggesting what, because I want you to learn how hedge funds, how big ticket mutual fund managers, and how big money thinks like. I want you to think like professionals. I'm here to help you think like professionals. So stick by with me. Now, the price tested its 7-month-old trend line, as you could have seen on the chart, and it managed to close above the trend line. Will it hold or will it crack? Time will tell. The price is below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook is weak, but for now. So the 94.5 level is an immediate support, which needs to be defended by the bulls, and you should watch out for this support in the absolute near term. Now let's move to the weekly chart and see a very large prominent bearish candle. That's almost a bearish engulfing candle. Why do I say almost? Because the open is slightly lower than the previous bullish candle's close. Be that as it may, it's a negative sign. The price has managed to hold above its 25-week exponential moving average, which is a 6-month holding on cost of an average buyer. So the medium-term outlook is negative for now. A weak dollar is bullish for emerging markets, so this has been partially responsible for the rally last week. Last week, I advocated a range between 98.30 on the upside and 96.15 on the downside, which was violated on the downside because of the Bank of England's rate hikes. Now, this is something that was triggered by news flow. And bond yields in the US hit 2-year highs. So obviously, there was bound to be turbulence. Now, the coming week is likely to see an estimated range between 96.65 on the upside and 94.25 on the downside. Watch this space very, very keenly in the coming days, my friends. Let's now go to the Bank Nifty, which gained 2.92% in the week gone by, and it rose on 3 out of 5 trading sessions. As you can see on your chart, the gains were on upper gaps and large, whereas the falls were relatively smaller. And do note, the daily chart shows a pattern of higher swing highs and higher swing lows. Now the price stayed above its 25-day exponential moving average, which is a month-long holding on cost of an average buyer. The short-term outlook therefore remains positive for now. The 38,000 round figure mark is critical to watch for signs of support and must be defended in case of dips. Moving to the weekly chart, we see a bullish candle, though the upper shadow shows that bulls surrendered some ground in the latter half of the week. The price remained above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. And that tells me that the medium-term outlook seems to be comfortable only for now. If the bulls manage to take and keep the price above the 40,000 level, that would mean it gives control to the bull camp without any doubt. What can cause this to happen, this sudden bullishness? I think probably the LIC's IPO is the most immediate feel-good factor effect in the market. In the week before last, this index was at number 12 on the most volatile list, but it shot up 8 notches straight to number 4. Last week, remember, the impetus of the Bank Nifty was far higher and stronger than the Nifty. So I said that volatility on the Bank Nifty would also be higher. Last week, I advocated a range between 39,400 on the upside and 36,000 on the downside, which held beautifully in spite of all that volatility because the high was at 39,425, my friends. A mere 25 point higher than the resistance that I advocated. This is all thanks to the IBEX, and I'm happy to tell you that this is my 66th weekly market outlook video, and the levels and ranges that I have been advocating have worked out on 63 weeks out of 66 weeks. We are not resting on our laurels. We are trying to keep on working to improve this average even further. Now, the coming week may see an estimated range between 40,500 on the upside and 37,100 on the downside. Do remember, the impetus and statistical beta is high, so price swings can be violent. Please trade light and maintain stop losses very diligently. Friends, I now come to the Nifty 50, which rose 2.42% last week, and this index underperformed the Bank Nifty because the price action was clearly in financials. Do note that the financial sector services contribute approximately 35% weightage in the Nifty itself. So it's these stocks that cushion the decline in the Nifty, which could have otherwise fallen even further. The index logged gains on 3 out of 5 trading sessions, that too by leaps and gaps, as you can see on your daily chart on your screen, because the markets were reacting to the budget. The latter half saw declines that took the price below its 25-day exponential moving average, which is representing approximately a 1-month long holding on cost of a bull. So the short-term outlook is weak, but for now. Moving on to the weekly chart, we see a smaller bullish candle as the upper shadow is prominent. It shows that the bulls surrendered part of their gains between Thursday and Friday. The price remained above its 25-week exponential moving average, which is a 6-month holding on cost of a bull. So the medium-term outlook is positive, but for now. Bulls absolutely must defend the 16,500 level in case of declines. And on the flip side, staying above the 18,000 level consistently will empower the bulls. Let's wait for the markets to tell us in which direction it wants to trade, and then we'll follow suit. In the week before last, this index was number 11 on the most volatile list, and that is precisely where it remained last week. Because volatility of individual stocks, especially banking, remained higher than the Nifty 50. The weekly range I advocated between 17,725 on the upside and 16,450 on the downside was overcome slightly on the upside because the peak was at 17,795, which is 70 points higher than what I had advocated. Now, this is something in my defense, not that I'm telling you why it should be allowed. In my defense, I had told you that this is a budget week and it would be much more volatile than usual, and therefore this kind of price action could happen. Mercifully, the IBEX was not very far off the mark, just 70 points. Now, the coming week is estimated to see a range between 18,150 on the upside and 16,850 on the downside. Friends, I would suggest you continue to trade light with stop losses in place and keep monitoring your WhatsApp inbox for updates from me whenever the market action demands such a move. Friends, now the index section done. I come to 5 stocks that are high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks of low beta, low impetus, where you take big exposure, and wait for small price moves. Why the difference? Because different traders, different attitudes, different mindsets, and therefore different strategies. So coming up on your screen are these stocks. The high beta list is led by Vedanta at number 1, number 2 AU Bank, number 3 Sun Pharma, number 4 IndusInd Bank, number 5 NMDC. Low beta, low impetus stocks where you take big exposure, wait for small price moves, led by Tata Communication at number 1, number 2 Polycab, number 3 LTTS, number 4 MRF, and number 5 NBCC. Friends, do note that this hierarchy can change from hour to hour, day to day, and therefore please connect with me on social media wherein I update these details every day at the end of the day so you can stay updated in the market and we can help each other become better traders. We can get conversations going about the markets, and I do thank you very much for the lovely response that you've given to me about being added to the WhatsApp broadcast list, and some of you have sent extremely positive feedback, for which I thank you from the bottom of my heart. Friends, before I wind up this video, in the description segment below this video are hyperlinks to my playlist on Equity Masters YouTube channel, wherein I share a couple of trading ideas and broad market picture every week. Do subscribe to their YouTube channel as well. And there is a PDF trading guide offer in the hyperlink below from Equity Master. Do avail of this offer as well. I also remind you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad, or ugly, your comments are always welcome. Friends, if you like my work, I would request you to forward my videos to your family and friends and help me reach out to more people who are looking out for knowledge and rational-based investments and trade. Do stay very safe from the Omicron virus. Thank you for your patience till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Stay connected with me on WhatsApp. Take care. Bye-bye.